So the Dow, S&P 500, and NASDAQ are all on track to finish this week in the green, with hopes for an Iran peace deal keeping oil prices just around $100 a barrel. This is all as markets power through the conflict. A growing number of brokerages are lifting their forecasts for the S&P. UBS thinks that the index is going to rally another 6% this year, citing resilient consumer spending and booming demand for data center infrastructure. And of course, investors are closely watching the Fed, where Kevin Warsh was just sworn in as Fed Chair.
Our mandate at the Fed is to promote price stability and maximum employment. When we pursue those aims with wisdom and clarity, independence and resolve, inflation can be lower, growth stronger, real take-home pay higher. To fulfill this mission, I will lead a reform-oriented Federal Reserve, learning from past successes and mistakes both, escaping static frameworks and models, and upholding clear standards of integrity and performance.
All right, David, desperate for your thoughts on what a reform-oriented Fed chair means.
Well, I love that he said it, and I love even more what he means by it. What he means by it is that the footprint the Fed has in the economy is too big,
yes,
and it has been for a long time. So we need a less interventionist Fed. Now, you notice he didn't say he wasn't focused on the actual mandate of the Fed, price stability, full employment. Whether people think the Fed can or should do those things, that is what Congress has tasked him to do. And he's saying, I'm focused on that, and not the Fed being the total arbiter of the economy, of all capital markets, this very robust view of the Fed that the last several Fed chairs have had. I really loved his speech, and I really love this appointment.
A quick follow, though. I'm looking at 10-year yields at a 4.57, a 30-year at a 5.08. And when you think about, instead of QE, expanding the balance sheet, more of a QT, reducing the balance sheet, if you're not the buyer of bonds, or you're actively letting them roll off or selling bonds, would yields rise further? And is there appetite for yields to climb further in terms of just like market anxiety around that?
Well, first of all, it doesn't matter because markets are supposed to figure out what the price of money is, not a PhD in a conference room. But all three times we ended QE 1, 2, 3 previously, bond yields fell down.
Okay.
So the fact of the matter is that it's an intervention, a distortion, more than it is an actual alleviation. 4 or 5 on a 10-year, we think that's too high. Like if we want nominal growth of 4.5 to 5%, that's what you want the 10-year to be. If inflation gets down to 2, if you get real growth of 2 to 2.5, you're going to have a 10-year around that level. So the main problem is not what it ends up being, because they can't control what real growth is in the economy. What they can control is the price of money distorting the economy, causing bad financial activity. The Fed, when they buy, they're not yield sensitive. You know who's yield sensitive? Savers, investors, real economic actors. That's where the price of money should go.
So, Lydia, I think what's also interesting, we talked about how UBS have had a slew of companies raising their price targets for the year-end S&P. I mean, long gone are the days when we thought the Iran conflict was going to sort of end things. And the equity market, the good news, it can kind of track inflation, it can track wage growth. And so this is a market that has powered higher, even in the face of higher yields, even in the face of higher inflation.
Yeah, I mean, even in the face of this ongoing conflict with Iran, which had me asking earlier myself, what's going to happen when the Iran conflict is eventually wrapped up? You know, as we see optimistic kind of comments coming from both sides, the U.S. and Iran, you know, if some type of deal is struck, as Secretary Rubio is over in NATO and talking to NATO countries as well, maybe we're poised to go even higher. I don't know, but wouldn't that be something remarkable? I want to come back to a thought that I had in the first hour, which is Kevin Warsh also saying that this is going to be a reform Fed, and kind of introduce a new idea that we haven't talked about yet, and that is kind of the Fed's relationship too with the wider public at large. How they're going to be communicating, how they're going to be communicating about the market and expectations. You know, he was critical of how much information was being put out by the prior Fed under Jerome Powell's leadership. And coming from a journalist perspective, you know, I guess someone from the outside looking in, trying to kind of glean information, I have questions about what a more I guess, protective or guarded Fed, if that's the direction he's going, whether that will be good and healthy. If I had a chance to sit down with Kevin Warsh right now, as respected and celebrated and important this moment is, as he's trying to kind of right the ship and regain broader credibility with the American public, I wonder what he's going to do with press conferences and dictating what's coming next for the markets and everyone.
Care to answer that?
I do not think that information from the Fed is the same thing as transparency from politicians or companies that have material information to share. Hedge funds front run the Fed. And what we had since 2008 was just an entire financial system of big money players front-running the Fed. So I think that there is a sense which many Fed governors use press conferences to go put things out there, and I don't think it's helpful. But I certainly believe that we can have them go tell us why they did what they're going to do. But using forward guidance to sort of hint at things that are going to happen, it basically creates bigger winners and then leaves other people out.
I feel like we've been talking, Jerry, about this disconnect. You have the markets at a record, but I mentioned the UMich readings where sentiment is, again, every time you think there's a bottom, there's a trap door and you fall further. But what's interesting is jobless claims, the weekly claims, are astonishingly low, 209,000. And so one report I'm reading says evidence is growing that pace of layoffs has slowed, and wondering if record low confidence is not in jobs and growth, but actually more in the president. And maybe that's how we should be looking at these surveys instead of a survey about your job prospects or the way you think the economy is going.
Well, or gas prices, which is something they see every single day, something I see every single day. When it costs you $80 to $100 to fill up your gas tank, you think things aren't going so well, right? It couldn't be that good. But I think you're right. The fundamentals, the wheels are still on the car, right? I'm really confident about that for sure.
Brian?
Don't you have a chart of the day for me or something? I've been waiting for like an hour and 10 minutes for a chart of the day on a Friday. You got nothing?
I have one, but it's on data centers, I think. So not this blog.
Can I say I'm fascinated by, David, you're just not that concerned about a 4.5 on the 10-year.
No, nobody should be. I would be very concerned if we had a 3.5. A 3.5 is called a recession. Okay, I mean, you can't. It's measuring growth over 10 years.
Yeah.
So what do we want the economy to be growing? If inflation is 2.5% to 3%, then we're talking about real growth well below 2. So we had basically 2% growth last year. This is way below what our country's used to. We grew at 3.1% for 70 years. So the idea that we want now look, a 10-year above 5% is in the range of starting to get problematic.
Okay.
But I think, and it would affect asset valuations.
Yeah.
But no, I think that 4 to 4.5 is the sweet spot that people want.
I keep hearing about the 30-year and like term premium increasing.
Yes.
And very concerned about that. Are you concerned about that?
I'm not, but keep in mind, people are talking about this as if it's a news story. It's been 4 times since 2022 that we've had yields go spike above these levels, and it's lasted a few minutes, including this time, by the way. It went above 4.6, and it came back down to 4.5.
Right.
The 30-year spread to the 10-year is a little higher. We do not issue 30 years anymore. There's not a lot of 30-year product out there. The 10-year is the most liquid, real measurement of cost of money in the world. And at 4.5, I'm just telling you the 10-year is not a problem. When people say they want it to be lower, I just want them to know what they mean by that. Do they mean that they want real growth to be less than 2%?
Yeah.
Good
But I'm interested then. So, okay. That we saw this fast increase in yields, right? I mean, we saw this rapid increase. My contention was that started the day we went into Iran and this conflict started.
It was a few days later. It was at 4%, and it went up to 4.3, and then it went from 4.3 to 4.5.
So I guess what I'm trying to understand is, I don't know what's going to happen with the Strait in Iran, but let's say either there's a deal or we just decisively get stuff moving through the Strait. Yeah. It strikes me that you might see the air come out of these yields relatively quickly.
Absolutely.
Is that crazy?
No, it's not at all. But there's two things going on. There's what you're talking about, which is oil prices and the long-dated bond yields went up together. So if oil prices do come down, those bond yields could come down. The other issue is that the neutral rate, the short-term rate, the expectation for that has gone up. That's not going to be oil specific. So as long as we think the Fed will not do anything, raise or cut rates, then you have a little bit higher short-term basis. All of this is very wonky stuff that most people don't care about. I'm with Jerry that people are looking at gas prices. I will say the consumer confidence thing is my biggest frustration in all financial media that we ever talk about.
Preach, David
It
Bonson.
is the dumbest
Friday,
data
you-ish.
point. It is, if anything, a contrarian indicator. It is wrong all the time. Unless you finally accept what I have, Americans love to feel bad about spending money.
This is my favorite block ever. You know exactly what I rest my case. The witness can leave the stand on bonds, on UMISH, on everything.
Let's talk about bonds. Stay with us. A new op-ed in the Wall Street Journal says people are actually probably over-invested in bonds. The piece argues that wealthy investors should abandon the traditional 60-40, which that probably hasn't worked in decades, but okay, and then go to 90-10 instead. Why? Well, because stocks maximize long-term growth, protect wealth against inflation, and are better protected from taxes. Yeah, David's shaking his head.
No.
There's just the idea that there's one formula for everybody is insane. Everyone has a different appetite for risk.
The story doesn't say that. The story is speaking to people who are retirees and people who have money, not people who don't have money.
Okay.
And they say that people in that category tend to be heavy bonds. And they're saying that 90-10 makes sense for those people, the very people that advisors for decades have been telling to be far more conservative. I thought it was interesting and contrarian because the piece is written by a former Fidelity president. And as to tell you what he has to say here, he goes through some numbers about the S&P 500 and its performance over many decades, and it is always beating bonds. My only point, because I do have a point I want to make here, is with bond yield, Treasury yields at these levels, and I can buy this with no intermediary, okay? I just go to treasury.gov and buy. I can lock that in risk-free.
Yeah.
2-year, why not? You know, you get it, you put it in that part of your portfolio, easy peasy. I don't buy bond.
Well,
you can't buy it risk-free. What you buy it is it's your principal's risk-free, but then in 2 years the bond yield could be 200 basis points lower.
I'm buying that yield. I'm holding that bond to maturity.
And then in 2 years you have reinvestment risk. So you don't have principal risk, you have a different risk. Look, the president of Fidelity is an executive. He's never had to go actually manage money for real people. 90-10 doesn't help anyone because it doesn't tell you what their appetite is, what their income need is. What is the yield right now in the S&P 500? The lowest it's ever been in history. So unless they're going to go sell the S&P to meet their withdrawal needs, they're getting 1% cash on cash. Now, if what they were was a dividend growth investor saying they wanted 90-10 because they were getting great juicy yields that were equal to the bond market with the growth of the market, like hypothetically we do at my firm, then yes, I agree with that. I agree with that advice. But I don't believe in any one size fits all without knowing what their principal needs are, what their income needs, risk tolerance, et cetera.
I will say quickly, one of the most interesting tests I took was CFA level 3, where all of it is portfolio management. And depending on every individual circumstance, the answer can wildly change based on liquidity needs or whatnot. So, but good story. And
that was the nerdiest block we've ever done in our lives.
And
that
you
was
loved
really
it.
I'll take that as a compliment.
And we loved it, and we're loving Deckers and Ross stores. You guys, huge demand. Deckers is up almost 1%. They own Hoka and Uggs. Hoka revenue is up 16%. Uggs are up 8%. UBSs are finally getting traction in the direct-to-consumer market. Ross stores surging. That is a record. They raised their guidance. Revenue is up 21%. Earnings are up 37%. They had increased customer counts across all income levels, age brackets, and ethnicities. So Ross is winning.
That sounds like low consumer confidence, huh? Do you see my point?
Well, could you?
This is the story that matters. That's real numbers. Ross, the revenues are up 20%. Every consumer company's numbers are up. All retail numbers are up. The only thing that isn't up is the confidence people have. It's just nonsense.
Okay. Well, my fight with you is we could have said Ross is winning because higher-end luxuries trading down to Ross.
But it isn't, though. That's the thing, is all level of retail sales are up. All levels of spending are up and have been. And by the way, historically, the only time real consumer activity in our country goes down is when people run out of credit. Americans love to spend money. How they feel about it is a lagging indicator, not a leading indicator.
So I won't bring up UMich next time you're here.
Thank you.
Good to know.